So I'd just like to briefly mention the impact of a tax on a good, and in particular how the elasticity of demand affects a tax. So if we take a good like, say, cigarettes, it's a popular choice for increasing tax. It raises about £7 billion for the government, and the reason we're able to raise so much money from cigarette tax is that demand for cigarettes is very inelastic. So when the government increases cigarette tax, firms are able to mainly pass on the tax increase to consumers. This is because demand is inelastic and consumers are willing to pay higher prices. If we have a look at this diagram, which I've drawn on the board, you can see that demand is inelastic. So when the tax shifts the supply curve to the left, we get a small fall in demand and a big increase in price. Basically, consumers are paying most of the tax burden. If demand was perfectly inelastic, then the whole tax increase would be passed on to consumers. However, if demand for cigarettes or for another good was elastic, then we can see that in this case, the tax, when it shifts supply to the left, it has a much bigger impact in reducing demand, and the price that consumers pay goes up by a relatively small amount. So when demand is elastic, it means the government will gain less tax revenue. So this is an important policy implication because it means that if goods are very elastic, sensitive to changes in price, there's only so much the government can tax it. But for a good like alcohol and tobacco, taxing is very effective because consumers usually pay most of the tax increase, and it has little impact on reducing demand.